The next big catalyst for the Federal Reserve. Markets currently pricing in 65% chance of a September cut. That's according to that CME Fed watch tool. So how could Friday's PCE print, that includes the Fed's preferred inflation metric, impact the path forward for the central bank? Joining us now to discuss, we've got Julia Coronado, founder and president of MacroPolicy Perspectives, to weigh in. Julia, thanks so much for being here with us this morning. We really appreciate it. Talk to me about what your thinking is heading into Friday's PCE print. If we do get that estimate, that 2.6%, what does that do to the chance of a September rate cut?
Yeah, thank you for having me. I think, we already have the May CPI. There was a lot of broad-based declines or moderations in inflation there that will show through to the PCE, plus some of the other details we expect to be quite favorable as well. So we could even see the annual rate round down to 2.5. It should be very close. And that's more progress. So the Fed has said it needs to see more progress. So far, what we've seen this year, even with the upside surprise to Q1, the monthly prints have been beating last year's monthly prints. And so the annual rate keeps coming down. And we expect that pattern to continue right through into the September FOMC meeting. They'll have several more data prints in hand. And we think that they're going to be favorable and that the Fed will, open the door in July and actually move forward with a cut in September.
It's progress and a pattern, but not the target we know, of course, for the Fed. Do you think that they need to change their target?
Well, the other thing, actually, no. I think that changing the target before we get to 2% would be something. Chair Powell has been abundantly clear that he's not interested in doing that. They are coming up on the strategy review, this sort of every 5 years thing that they're going to be doing, and they will reevaluate potentially something like the target. Should it be a range? Should it be a point estimate? But I think that's not for now. For now, they want to get close to and hit that target before they ever have discussions about, changing it. That would be a potential hit to their credibility. You don't want to move the goalpost in the middle of the game.
Well, it's interesting, the conversation about that upcoming debate about, the Fed's tools, because we recently got some housing data in that I want to get your take on, Julia. We're seeing housing starts not really there. Supply isn't there. It's making prices sticky in the housing market. How much will the dynamic between the Fed's rate hike cycle and the impact that has on housing potentially continue to weigh on something like core PCE moving forward? And does that indicate kind of a sickness within the tools that the Fed has, given that raising rates keeps people locked into housing, which then leads to inflation in other areas? I'm just curious your thinking on that broader dynamic.
Yeah. No, it's a great question. And really the Fed, they have time, but they are starting to get closer to those trade-offs of are your high rate policies actually going to do more damage than good? The trade-off they're facing is, do you start a process earlier and go slowly so you can calibrate what is the neutral rate versus waiting until the economy really weakens? We've seen a little bit of cooling in consumer spending, some cooling in the labor market. I think so far it's within the realm of what the Fed wants to see. But again, that means you're getting closer to where those trade-offs might be binding in one direction or another. When it comes to housing supply, that's an excellent point because high rates do impede supply. There still is excess supply of multifamily housing coming onto the market. Really, this will be a full year of excess supply, more than likely, which is going to keep downward pressure on rents. But the Fed is going to need to begin lowering rates soon if it doesn't want a more binding bottleneck in supply to materialize over the next couple of years. At these rates, we are not seeing interest in building housing, and we know we need more supply there. So I think it will be very constructive for the Fed to at least initiate a sequence of cuts. They don't need to go all the way back down to zero. But maybe uninverting the yield curve and getting mortgage rates to a point where we actually see movement in the housing market would be a very healthy development for the U.S. economy.
Julia, just a few minutes ago, we were discussing some of the companies, equity market companies, that are at the tip of the tongue for a lot of households out there that are navigating their own personal or household economy. And we're going to hear from some of these companies that are going to be describing the economy in their own macro lens. What do you expect to continue to hear from companies like Nike, like FedEx, as they give us a little bit more of their insight on that macro lens over the course of this week and kind of set up what the tenor may be for the next earnings season?
Absolutely. It's been an interesting earnings season so far because consumer-facing companies have reported a few key themes. One is that consumers are price sensitive again. That's good news for the Fed. That's good news for inflation. Consumers want a deal. They are now spending their hard-earned cash, not stimulus, and they are spending the full range of goods and services, unlike during the pandemic. So they're actually quite picky and they want a deal to part with their cash. So, I think we would not be surprised to hear that from companies like Nike. And FedEx might also indicate that consumers still remain a little bit tilted towards service spending over good spending. Consumers binged on good spending during the pandemic. They've kind of loaded up a lot and are less interested in it lately. And so we might hear that as well. And that all of it says that these higher interest rates are doing their work, cooling the economy down, making consumers more cautious, more price sensitive. And we're still in the realm where that's good news, but we don't want to necessarily see that go much further.
Julia, I'm going to ask you to hop in and do our job for us here because we've got an exclusive interview with Janet Yellen from Yahoo Finance later today. If you could sit down with the Treasury Secretary, what is one question that you would want to ask her about the current state of the economy?
Secretary Yellen, I saw her speak at an event last week or the week before, and she was describing what she's calling modern supply side economics. And I don't think that's necessarily gotten the attention that it deserves. So one question that I would have for Janet Yellen is, back in 2016, she described what she called the high pressure labor market. And maybe if you ran policy such that you have a high pressure labor market, and some companies would be incentivized to invest, and we could actually see a boost to productivity. So I would ask her, Secretary Yellen, do you think you're seeing the dividends you expected to see from running a high pressure labor market, a more productive, efficient, resilient economy? Is that part and parcel of the policies that were chosen during the pandemic?
Julia Coronado, who is the founder and president of MacroPolicy Perspectives. Thanks so much for joining us here today. Really appreciate it.
My pleasure.